What if I told you there's a US energy company paying a 6.88% dividend, just raised it again, and posted rock-solid Q1 earnings, but no one's talking about it? Is this the safest high-yield stock in the market right now? Let's find out. Enterprise Products Partners, established in 1968, is one of the largest midstream energy businesses in North America, providing a wide range of services to producers and consumers of natural gas, crude oil, natural gas liquids, NGLs, petrochemicals, and refined products. The company owns an extensive network of pipelines, storage facilities, processing plants, and export terminals. Enterprise generates revenue through long-term, fee-based contracts for services like transportation, processing, storage, and fractionation, helping customers move energy products from production sites to end markets. The company is currently offering a starting dividend yield of 6.88%, while the 5-year average yield stands at 7.52%. The current price-to-DCF ratio is 8.2, compared to a 5-year average of 7.7 and a sector average of 8.6. The expected fair value range for the stock is between $26 and $32, while the current market price is $31.68. Based on these metrics, the stock appears to be fairly valued at the moment. The company currently pays an annual dividend of $2.18, distributed on a quarterly basis. The next dividend payment will be on August 14th, and shareholders must own the stock by July 31st to be eligible. The dividend has increased by 4.1% over the past 12 months. The 5-year average dividend growth rate is 3.5%, while the 10-year average is 3.8%. The company has consistently paid and increased its dividend every year for the past 26 years. The DCF payout ratio has been showing a declining trend for years and is currently more than 30% below the expected level. Further decreases are anticipated in the next 12 months, which is very reassuring, especially for a company with a starting dividend yield above 5%. DCF share is steadily increasing year after year, which is very important as it indicates the company can continue to pay and raise dividends in a stable manner. DCF per share growth and sales growth are quite volatile, but this is not surprising in this industry. The company also started a share buyback program a few years ago, which is something every investor likes to see. Total sales are also quite volatile, similar to the DCF and sales growth, which is completely normal. Net debt to EBITDA has been on a nice declining trend for years and is currently well below the expected level of 4.5. Net debt to capital is also below the expected maximum level, and the interest coverage chart looks very strong. The company is currently available with a starting dividend yield of 6.88%, and the dividend was increased by 4.1% over the last 12 months. The credit rating is A-, which is considered good, and the dividend also appears to be secure. Based on these factors, the company is currently available at a fair price in the market. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Let's start with what income investors care most about: dividends. In Q1 2025, EPD paid a distribution of 5.35 cents per unit. That's a 3.9% increase year over year. But here's the kicker: since this report, they've already announced another dividend hike. The next payout will be even higher, and it's scheduled to hit accounts in August. So, while most companies are freezing or cutting dividends, Enterprise is doing the exact opposite and rewarding unit holders consistently. And it's not just dividends. In Q1 alone, they repurchased 1.8 million units worth $60 million, showing that management sees real long-term value in their own stock. Total capital return to investors over the past 12 months, a massive $4.8 billion through distributions and buybacks combined. Now, what about the company's ability to sustain those payouts? The answer lies in cash flow. EPD posted a trailing 12-month payout ratio of just 56%, and their leverage ratio stands at 3.1x, right within their target range. This company doesn't overextend, and with $3.6 billion in available liquidity, they're more than prepared for macro shocks. Even more impressive, They've raised their distribution for 26 consecutive years, through recessions, oil crashes, and even the pandemic. And they're not sitting still either. Right now, they have $7.6 billion worth of major capital projects under construction, most of it tied to natural gas and NGLs in the Permian Basin. Nearly $6 billion those projects are coming online in 2025, meaning more cash flow, more throughput, and more value for investors. Now let's look under the hood, segment by segment. Total gross operating margin came in at $2.431 billion, just slightly down from last quarter and flat versus last year. The NGL segment carried the team again, contributing $1.418 billion, up from $1.34 billion a year ago, thanks to increased volumes in the Permian and higher ethane exports from Morgan's Point. Natural gas and refined products showed strength too, but petrochemicals and crude oil saw margin compression, mainly from lower spreads and weaker pricing. So let's zoom out. You've got a company with growing cash flows, a 6.88% yield, 26 years of dividend hikes, and billions in growth projects coming online soon. In this market, that's rare. Enterprise Products Partners may not be flashy, but for long-term income investors, it just might be one of the most reliable plays out there. NVIDIA just posted $44 billion in revenue, up 69% in 1 year. Their cash flow, through the roof. But here's the real question. Is it too late to buy, or is this just the beginning of something even bigger? Stick around, because we're diving deep into their latest earnings, future growth potential, and whether NVIDIA is still a smart investment in 2025, based on both fundamentals and dividend safety. NVIDIA, established in 1993, is a global technology company best known for its graphics processing units, which power gaming, artificial intelligence, data centers, and autonomous vehicles. The company generates revenue primarily from selling GPUs used in gaming consoles, PCs, and workstations, as well as from AI-focused chips used in machine learning, cloud computing, and high-performance computing applications. NVIDIA is a leader in AI innovation, with its GPUs playing a critical role in powering large language models, automated systems, and data center infrastructure. NVIDIA is currently available with a starting dividend yield of 0.03%, compared to its 5-year average of 0.06%. The price-to-earnings ratio is currently 33.2, while the 5-year average stands at 42.2 and the sector average is 27.8. The expected price range is estimated to be between $182 and $223, while the stock is currently trading around $159, suggesting it appears to be undervalued based on these figures. The company currently pays a dividend of 4 cents on a quarterly basis. The next dividend payment is scheduled for October 3rd, and shareholders who own the stock by September 12th will be eligible to receive it. However, it's likely that not many investors hold the stock primarily for its dividend. There was no dividend increase in the most recent year. The 5-year average growth rate stands at 16.3%, while the 10-year average is 14.9%. The company has been paying dividends consistently for 12 years and occasionally increases them. The earnings payout ratio has historically been above the expected 50%, but in recent years it has dropped significantly, so there's no cause for concern. The same is true for the free cash flow payout ratio. Given that, it's no surprise that both earnings per share and free cash flow per share have been growing steadily. Based on expectations for the next 12 months, this growth is not expected to slow down. On average, the company has managed to double these figures year over the past 5 years. The shares outstanding chart shows a consistent downward trend, while the total sales chart demonstrates steady year-over-year growth. Return on equity and return on invested capital are also at exceptional levels. Operating margin and free cash flow margin have been consistently around 50 to 60% for years, while the minimum expectations are approximately 16% for operating margin and around 5% for free cash flow margin. Debt is virtually negligible. The company currently holds so much free cash that management doesn't see the need for significant borrowing. Investments and developments are financed with internal cash, which continues to generate increasingly higher returns. Interest coverage is also at extraordinary levels. The company is currently available with a starting dividend yield of 0.03%. There has been no dividend increase in the past 12 months. Its credit rating is AA-, which is considered very strong. Based on this data, the company still appears to be undervalued, but slower growth may be expected in the near future compared to the past 2 years. Let's dive into NVIDIA's latest earnings report, Q1 of fiscal year 2026, and see how they're performing today, how they got here, and what the future looks like. Year over year, NVIDIA's total revenue skyrocketed by 69%, reaching $44.1 billion. The major driver? Their data center business, which grew by an astonishing 73%, all thanks to surging demand for AI computing. Hyperscalers like Microsoft, Google, and OpenAI dramatically increased token generation needs, and NVIDIA's Blackwell chips were ready. In fact, Blackwell now accounts for nearly 70% of all data center compute revenue. Gaming wasn't left behind either. Revenue from gaming rose 42% year over year, hitting $3.8 billion, a record high, driven by Blackwell adoption among gamers and creators. The RTX 5060 and 5060 Ti launches brought high-end architecture to the mainstream. Even with a $4.5 billion inventory write-down related to H20 chips restricted by export controls, net income still came in at nearly $19 billion non-GAAP. That's up 31% from a year ago. Cash flow from operations reached $27.4 billion, a 79% year-over-year increase. NVIDIA ended the quarter with over $42.5 billion in net cash. Compared to last quarter, NVIDIA's revenue grew 12%. While gross margins declined due to the H20 inventory hit, they're still healthy at over 61% non-GAAP. NVIDIA is now shipping 72,000 Blackwell GPUs per week to hyperscalers, and they're expecting even more in Q2. NVLink revenue alone exceeded $1 billion in Q1, signaling a new growth vector. Other segments like professional visualization and automotive also saw strong momentum. Automotive revenue jumped 72% year over year, driven by demand for next-gen self-driving and AI vehicle stacks. Looking ahead, NVIDIA expects Q2 revenue to hit around $45 billion. But note, this includes an $8 billion reduction from lost H20 revenue due to export restrictions, mostly in China. Despite that, gross margins are projected to improve to 72% non-GAAP, thanks to stronger profitability on Blackwell shipments. On the tech front, NVIDIA just launched Blackwell Ultra, a rack-scale system with 72 GPUs and 36 CPUs acting as one massive GPU. It's 1.5x faster than the previous generation and increases AI factory revenue potential by 50x. They're also rolling out their open-source inference platform, Dynamo, and new Llama-based reasoning models. These developments show NVIDIA isn't just chasing performance, they're defining the AI software ecosystem. And finally, they plan to manufacture AI supercomputers in the US for the first time, with production capacity reaching $500 billion worth of infrastructure in the coming years. So is NVIDIA still a buy? While growth may slow in the short term due to regulatory constraints, long term, their position in AI infrastructure and innovation looks stronger than ever. Before Q2 earnings drop, let's take a step back and ask, is Johnson & Johnson still the rock-solid dividend machine it's known to be, or are cracks starting to show beneath the surface? In this video, I'm breaking down the fundamentals and the key takeaways from J&J's Q1 2025 earnings. What's working, what's not, and what it all means if you're holding, buying, or thinking about adding before Q2. Let's sharpen your edge. Because investing blindly in a blue chip is still a risk if you don't know what's really going on under the hood. Established in 1886, Johnson & Johnson is a global leader in pharmaceuticals and medical devices. The company develops prescription medications for various therapeutic areas, including oncology, immunology, and neuroscience. Its medical devices portfolio encompasses products for surgery, orthopedics, and vision care. The company is currently offering a starting dividend yield of 3.34%, compared to its 5-year average of 2.77%. Its current price-to-earnings PE ratio stands at 14.7, which is below both its 5-year average of 16.2 and the sector average of around 15.9. Analysts estimate the fair value to be somewhere between $169 and $207, while the stock is currently trading around $155, suggesting that it may be undervalued at current levels. The company currently pays out $5.20 in dividends, distributed quarterly. The next dividend payment will be on September 10th, and it will be paid to everyone who holds the company's shares by August 27th at the latest. The most recent dividend increase was 4.8%. The 5-year average is 5.5%, and the 10-year average was 5.9%. A slight downward trend can be observed, but let's not forget that Johnson & Johnson has paid dividends every year for 109 years, and in the last 62 years they have increased the dividend every single year. The earnings payout ratio has regularly been below the expected 60% over the past 10 years. The free cash flow payout ratio experienced a 4-year fluctuation, exceeding the maximum limit, but based on expectations, this won't be an issue in the next 12 months. Both earnings per share and free cash flow per share have been steadily increasing year over year. There were some minor issues in the last 4 years, but hopefully the pattern will not continue and we will see 2 consecutive years of revenue growth. In contrast, free cash flow per share has been continuously increasing. As expected for a company like this, shares outstanding have been steadily decreasing, while the total sales chart shows consistent growth. Return on equity and return on invested capital have been well above the expected level, except for 1 year, and I believe this will remain the case in the future. The same can be seen in the operating and free cash flow margin charts. These are quite reassuring numbers. Now, let's talk about where most companies fail, if they haven't already: debt. Debt is very important in any company's life, and even as an individual, leveraging debt can lead to big gains if you are well informed or simply want to accelerate things, such as buying your first apartment or house. As we can see, Johnson & Johnson has no issues managing its debt properly, staying well below expected levels, so the interest coverage is flawless. The company is currently offering a starting dividend yield of 3.34%. The most recent dividend increase was 4.8%, and it holds an AAA credit rating, which is very strong. The dividend also appears to be very safe, suggesting that the company might be undervalued based on these factors. Let's jump into Johnson & Johnson's first quarter results for 2025. Revenue came in at $21.9 billion, up 2.4% year-over-year on a reported basis and 4.2% operationally. Adjusted EPS was 277, up 2.2% from last year. GAAP EPS came in at 454 cents, a 239% increase compared to last year, driven by one-time items and tax benefits. Free cash flow was approximately $3.4 billion, and JNJ paid out $3 billion in dividends to shareholders. Innovative Medicine segment. Innovative Medicine generated $13.9 billion in revenue, a 4.2% operational increase. Oncology was the top performer, with strong sales growth from Darzalex, Erleada, and Tecvayli. The newly launched combination therapy Rybrevant/Lazcluze showed a significant survival benefit over the standard of care in EGFR-mutated non-small cell lung cancer. In immunology, Tremfya performed well due to market share gains and its new Crohn's disease indication. Stelara and Imbruvica, however, declined due to biosimilar competition and Medicare Part D redesign impacts. Neuroscience and other therapies. Spravato grew steadily thanks to increased demand from both physicians and patients. On the flip side, long-acting injectables like Invega Sustenna, Trinza, and Travicta declined due to the Part D changes. Medtech segment. Medtech brought in $8.22 billion in revenue, a 4.1% operational increase. Strong performance came from Shockwave Medical, Impeller Devices, and the Vision segment, especially with the AcuView Oasis one-day lenses. Orthopedics, however, was impacted by one-time events, including fewer selling days and an ongoing transformation program. 2025 outlook. J&J raised its full-year revenue forecast to $91.6 to $92.4 billion, reflecting 3.8% operational growth at the midpoint. Adjusted EPS is expected to be between $10.50 and $10.70, a projected 6.2% growth from last year. They also indicated that the second half of 2025 will likely see faster growth as newly launched products gain momentum. The Intracellular Therapies acquisition is expected to contribute positively by year-end. Risks and headwinds. Stelara is facing increased biosimilar competition, and this is expected to accelerate as the year progresses. Other impacted products include Imbruvica, Tremfya, Uptravi and Iliada, mainly due to the Medicare Part D redesign. Pipeline and milestones. 2025 is shaping up to be a pivotal year for J&J's pipeline. Key developments include Capleta for major depressive disorder, Tremfya sub-Q for ulcerative colitis, Rybrevant sub-Q for lung cancer, and Icotrokinra, a first-in-class oral peptide for psoriasis and UC. Some of these drugs are projected to outperform current market expectations by 2 to 3x by 2028, according to internal forecasts. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.